The Reserve Bank has hiked rates as expected, but contrary to expectation, it did not reassure that this is the last of the rate hikes, nor did it hint that there will be another rate hike. On stance, it retained withdrawal of accommodation and didn't quite guide when and how it will change its stance. The only hint was the governor's and the MPC statements repeated worries about inflation, especially core inflation, and how far the MPC is from the target of 4%. Let's listen to the governor.
Core inflation, however, remains sticky. Looking ahead, while inflation is expected to moderate in 2023-24, it is likely to rule above the 4% target. The outlook is clouded by continuing uncertainties from geopolitical tensions, global financial market volatility, rising non-oil commodity prices, and volatile crude oil prices. The MPC was of the view that further calibrated monetary policy action is warranted to keep inflation expectations anchored, break the persistence of core inflation, and thereby strengthen the medium-term growth prospects.
With that preface, let me invite our guest, Mridul Saggar, the former member of the MPC, now a professor at IIM, Pranjul Bhandari, Chief India Economist at HSBC. Those are the two economists, and the two bankers and bond experts, Ashish Parthasarthy, Treasurer at HDFC Bank, and B. Prasanna, Head of Global Markets Group at ICICI Bank. Gentlemen and Pranjul, thank you very much indeed for joining me. Well, let me start with you, Mridul. That was the biggest quandary of the policy statement. I thought that we don't have a very clear guidance of what next. What's your best guess?
So I think it is something good that there's no clear guidance, because we are in an environment which is highly uncertain at the moment. And clearly, while base case is that the global growth is slowing down, more incremental data leaves us pretty confused over what's happening, what will be the extent of slowdown, what will be the spillover from the global slowdown to the Indian GDP. I think these are the uncertainties we need to worry about a bit. And it's not the job of the monetary policy to keep giving forward guidances all the time. I mean, that kind of limits the options which the policy has. So if I look at, sorry, okay.
So basically you're saying no stance, and you are vociferously defending the fact that they have not given a guidance. Well, let me toss that to Prasanna. You know, you and Ashish, Prasanna, don't have the luxury of not guessing a stance. So if you have to guess what they would do next, do you see seeds of another hike there?
So I think, Lata, to start with, I'll have to, I think, accept what Mridul Saggar just said. I think we are in a situation where data dependency is going to be key. And if you really look at the first year after COVID, it was clearly rates were going down, and then the second year rates were clearly going up because of inflation. But you reached a situation where data could go either way, and we have reached a level of rates which is substantially, on the higher side. So it's difficult either way. So having said all this, I think RBI chose this path because of the fact that the Fed it's also not very clear where the Fed is going to stop. So I think having all cards close to their chest is a good strategy for them. And like you rightly said, if we have to, kind of take into account what kind of stance it is going to be going forward, I would again say that I think it's a kind of a 50-50 kind of a thing. While earlier, before the policy, I was thinking that this would be the last rate hike, and I was reasonably confident on that prognosis. But now when I, especially the data which has come out of the US just last Friday, the jobs data, and, the very possibility of the Fed hiking well into the Fed rate of 5.25, and the RBI keeping all cards close to its chest, not wanting to indicate where they are headed or where the peak is. And the fact that the narrow interest rate differential means that the rupee at the margin will be having a pressure. So from all that perspective, I think you can't discount another rate hike. So if the Fed were to go to 5 to 5 quarter kind of a range, which means 2 hikes in the next 2 policies, it's very much possible that there might be another hike, but it's a 50-50 kind of a thing.
Okay. Okay. Ashish, well, a kind of similar question to you, but if you could give a range, the market hardly moved today, obviously because the hike itself was largely on expected lines. But what kind of a range and what would you prepare for? Do you see the yields going to 7.5 because there is a large borrowing program and global banks are aggressive or hawkish, as Prasanna says?
So see, 7.5 is really not very far from where we are today, right? And with
Okay.
the kind of supply which will come through, and if by then, when we start the borrowing program, that is in April, and we have 2-3 rounds of borrowing from April and May and June, by the time it should be very clear that has there been another rate hike, or are we in the same situation as we are today? Maybe even after the next policy, there could be another hike, or there may not be. I think we will continue to see a reasonably ranged yield movement. I would say I think the downside is limited in terms of movement in yields, and unless inflation numbers surprise everyone to the downside. So I think it would range more between 7.20, 7.5. That's the kind of range I would expect the 10-year to be in the first few months of the financial year.
Okay, I'll come back to both of you on with perhaps a few more doubts on whether the borrowing program will sail through. But now let's come to the inflation forecast itself. All through FY24, the Reserve Bank doesn't see inflation going below 5%. The best is FY24 Q1, where they're expecting 5%, and then it goes on to 5.4, and then 5.6. Pranjul, is this more hawkish than you would have forecast?
No, to be fair, Lata, I'm quite happy with this inflation forecast. As in, I understand that we have a good Rabi harvest to look forward to, and after that, food prices could fall a little bit. But on the other hand, core inflation has been extremely sticky, and if growth slows, core can come off a little bit, but I doubt it can fall quite sharply, simply because there have been a lot of structural changes in the economy through the pandemic. For example, large firms gaining pricing power, the fact that there are too many import tariffs that have raised the cost structure of the economy, and I don't think core will come down very easily. So, there are a few things I'm a little uncomfortable with in this policy, but inflation forecast, is not one of them.
What are you uncomfortable with?
Two things. One is growth. I think the growth number is extremely high. First quarter, 7.8% is something I think it's not possible. In fact, our growth forecast for the year is 5.5%. And I think even that looks a little rich because it assumes a huge sequential increase. So growth is one. And then the other thing is real rates. My sense is that the target has been changed. There was a report last year which said that real rates of about 1% is where neutral is. But right now, real rates are close to 0.9. The RBI came out with that today in the policy meeting.
Yes.
But it basically said that, that's too low. We need it to be higher. We need to go back to pre-pandemic levels. So in a way, the goalpost on real rates has been changed. The bar has been set much higher. And I think that made me a little uncomfortable. Why this big change suddenly?
Okay, well, I'm not very sure the governor defended that he will want to go back to the pre-COVID real rate. And for those of you who don't like this kind of jargon, when economists say real rate, it is the difference between the interest rate and the inflation rate. So now the interest rate repo rate is 6.5. Inflation forecast is at 5.6 for this quarter. Difference is 90 basis points, which is what Pranjul is referring to. Mridul, both these questions actually, but first with the growth forecast. Are you as uncomfortable?
So I do see a small downside bias to the growth forecast which the RBI has given. We'll be lucky to get at 6.4 or what the economic survey says 6.5. On the base case, it does look, seeing what the momentums would come and also the base effects, there could be a 25 bips downside to those sort of numbers, but that's not very material, I think. Also, I agree with Pranjul that maybe inflation numbers are not so bad, but there is also a small upward bias in the RBI forecast as a base case to my mind. But pretty much, it's not just the core inflation stickiness which worries me, that obviously the monetary policy needs to crack. But food inflation has fallen sharply, and it's not necessary that going into second half that may be the case. Even today, there are considerable pressures in momentum on prices of milk, of cereals, of eggs, fish, meat, so the protein items. So we need to be cautious on too low an inflation, but yes, if global growth collapses, then obviously the inflation would also, global inflation will collapse and some pass-through will come. More recent data is pretty mixed on the global growth. I mean, the payroll number in the United States, the collapsing prices of energy in Europe, when the natural gas, the CNG prices are outcompeting the gas prices. And we see China reopening, having a significant positive effect, but we don't know where it will go. But Japan also, the growth looks better. So that's where it doesn't look the global growth may collapse the way markets were anticipating.
That can endanger the inflation forecast, as you put it. But by the way, Mridul, like Pranjul, a bunch of economists think that 6.4 is a bit too high. Perhaps one reason is that we've got a 7% GDP forecast for the current year from the NSO. The RBI's own forecast was 6.8. So simply to adjust to that arithmetic, maybe you had to push FY24 also a little higher. But 6.4 is not really anyone's forecast at this point in time. It is really an outlier, comes at the higher end of at least the people whom I polled, where 5.8 to 6% is the kind of growth expectation. But so there it does seem some kind of optimism or something the Reserve Bank knows, which we don't. We have to ask our bankers a few more questions on how the borrowing program will go through, the insurance borrowing and lending mechanism which the Reserve Bank has announced. All those in a minute after this break. Welcome back to this special show on the monetary policy statement that has been announced and the 0.25% hike that the Reserve Bank announced. I've been speaking with economists Mridul Saggar and Pranjul Bhandari and bankers and bond experts Ashish Parthasarthy and B. Prasanna. Ashish, Prasanna, I'm coming to you all in just a minute on this, what seems a coordinated game, the tax on insurance guys, at the same time, a lending borrowing mechanism opened for them on the CCIL. I'm coming to that in just a minute. One word on the macro setup from Mridul. Mridul, what did you make of the real rate, the one that Pranjul referred to? Do you think the Reserve Bank will want to go over 2%? Or was it just a reference and they may perhaps stop when it is about, say, 1/4 or thereabouts?
So firstly, I'll clarify that I don't believe our star in India is like 1%. The real neutral rate cannot be 1% in a country like ours. It should be slightly higher, but anyway, that's an issue of calculations among various central banks. Everyone seems to have gone overboard on pulling down the R stars. Let me also clarify another thing. See, before this 25 basis point hike, the transmission was, to my mind, pretty incomplete. And I have been making that point that a weighted average term deposit rate, to me, that's the most relevant real rate to watch, more than the new real policy rate. And that was negative, which is now turning out to be positive after this 25 basis hike in December. But even if I assume that all 25 basis points are passed on nominal rates, and we take RBI's inflation rate as given, we would actually end up with something like 0.65 real positive policy, the deposit rates, three quarters down the line, which is not large. I mean, typically these have been around 3% real rates, the deposit rates in a long-term average. So I don't know what we are complaining about here. Think about the weighted average lending rates. They would still be well below the long-term averages.
Fair enough. Okay, if you're going to say the deposit rates have to be 3 percentage points above the inflation, our bankers are going to get really blue, hot and cold. But Ashish, let me come to the borrowing, the program itself. You know, it's a good 15.5 lakh crore, much like last year. And this time, the insurance companies may not come. for the simple reason that the guaranteed product is the one that has got that tax. The HNI will no longer perhaps be willing to have too many guaranteed insurance products. And if you don't get, I think last year they bought some 2 lakh crore, or last year, no, this year they bought about 2 lakh crore of bonds. Do you think without that, this borrowing can be that easy?
So, no, the borrowing the number looks large, but we have to also realize that we are obviously a growing economy, right? The notional growth rate would be upward of 10%. So the demand drivers for bonds would be banks, banking system, balance sheet growing. And we also need to understand that over this year, the surplus with banks would have come down, given what has happened with deposit rates and deposit growth and credit growth. Second is the provident and pension funds. Again, they are an increasing corpus, right? Given what we are given our demographics and given notional. Even insurance companies, if you've heard them, they've said it will impact possibly by 10 or 15%, right? And otherwise they would grow. So I don't think demand will be too much of an issue. At best, there could be something at the margin, but it's not going to be a big issue at all in terms of demand for government bonds. So
for the better part of this year, you wouldn't worry about yields, you're saying? You don't see them flying away?
I won't worry about it. I don't see it flying away. As I've said before, they should be in a range. There could be some, because of technical issues or because of some periods where possibly there is no demand in that 1 or 2 months. And, so those could be issues which, which we have always seen, but which has got managed either by OMOs or by auctions being cancelled, size reduced or something like that. So I don't think it's a big issue demand.
Okay. Prasanna, a similar question to you. I mean, are you also not that terribly worried about, insurance companies not coming and doing forward rate agreements with you, asking you to warehouse bonds for them? Secondly, this borrowing lending mechanism, at the press conference it became very clear it was intended for insurance companies. It will be in the CCIL. Will that have a bearing on the yield curve?
So I'll try to answer it very quickly since Ashish has given a very detailed reply, Lata. I think I would be slightly worried about the borrowing program, but not just because of, insurance companies potentially not coming to the extent they came. It's also because of the fact that when we are comparing gross borrowing and net borrowing, we are comparing it with this year and the next year. And then we are saying that there's a nominal GDP growth, so the entire economy is growing. However, you have to note that the beginning of the year, we had a huge surplus liquidity in the banking system, and that liquidity is now down almost to zero, maybe give or take a few lakhs of crores. So from that perspective, I think the banking system is going to operate in a liquidity neutral, marginal liquidity surplus kind of an environment. So to that extent, the marginal propensity to buy government bonds is going to be that much lesser. Second, more important thing is also that I would have probably assumed that if the peak to the rate hike cycle is very, very close, then maybe to some extent borrowing can go through much more easily. But after having seen what's happened today, where all the cards are now close to RBI's chest, it's quite possible that there is a little bit of uncertainty with respect to what's going to happen to short-end rates. So if short-end rates are also going to be under pressure because of the potential, let's say, one more rate hike, then it's quite possible that the rest of the yield curve can also, kind of drag up. And also remember that the SDL supply is going to be higher. All this can be compensated by, a global bond index inclusion, which unfortunately doesn't look like a real possibility at this point of time, maybe. Or could, in the second half of the year, open market operations might be required by the Reserve Bank of India. So I think
that was going to be my next question. That was going to be my next question. And actually, we are running out of time. So, Mridul, if you can keep it short, should we expect OMO or even a CRR cut?
Not really at this moment. So clearly, if situation changes, all policy options should be kept open. That's why I'm saying we have to be very nimble and flexible in times to come, but not immediately this time.
Okay. Can I have a rapid fire? All of you, please tell me what do you expect in the April policy? Hike or pause? Prasanna first.
Pause, Lata, but I can't rule out at 25.
No. One word. Pause. Ashish?
Pause.
Pause. Pranjul?
Pause and no change in stance.
Okay, thanks. Mridul?
Data dependent, maybe pause this time, but not that doesn't mean you need to raise every time.
Oh, that has to be like RBI. Very quickly, only for the bankers, rupee, Prasanna, what is the likely range? Any depreciation or appreciation?
So I think, Lata, it will be a depreciating bias, but of course, a lot depends upon when the Fed peaks. When the Fed peaks, you will see a dollar weakening. So INR can benefit at that time, but not immediately.
Okay. Ashish, 84?
82 to 84 broad range.
Oh, right. Okay. Okay, I will have to call it a day. Lots more questions, but I think it's been a relatively simple policy. On expected lines on hike and slightly unexpected perhaps on stands, completely close to the chest on what they will do next. Thank you very much, Ashish, Prasanna, Mridul and Pranjul for joining me. We wrap up on this special show.